All right, let's dive in. We are going to break down what might just be the most important week of 2025. The entire global financial chessboard is shaking, and if you're not paying close attention to these key moves, well, you could easily get caught off guard. So let's map this all out. This quote right here, it absolutely nails it. We're standing at a critical moment where the old rules of investing, they're being ripped up right before our eyes. Honestly, the stakes for protecting and growing your capital have rarely been this high. So, what's actually driving this earthquake in the markets? Well, it really boils down to two massive tectonic plates colliding. On one side, you have the world's most powerful financial institutions, the central banks, all pulling in completely different directions. And on the other side, you have global tensions that are literally redrawing the map of risk and opportunity. Let's start with that first force. For years and years, the story was always one of coordinated action, right? Central banks were all moving in lockstep. Well, that era is over. It's done. We are now in a period of pretty profound divergence, and that creates friction, it creates volatility, and a whole lot of unpredictability in the global system. Okay, now what's really fascinating here is how clearly this shows three completely different paths for the three most important Western economies. So in the US, the Fed just cut rates, saying the labor market is cooling down. But the real story is in their internal projections, what they call the dot plot, which basically tells you where each Fed member thinks rates are heading, and that suggests they might just hit pause soon. Meanwhile, over in Europe, the ECB is holding firm. President Lagarde says they're in a good place, and they're not rushing to do anything. And then you've got the UK, where pretty much everyone expects the Bank of England to deliver a little cut for Christmas to juice a weak economy. For currency traders, this is an absolute playground. But for the rest of us, it just means that your assets, whether they're in dollars, euros, or pounds, are all now under very different kinds of pressure. Now, this split in what the central banks are doing, it isn't happening in a vacuum. It's colliding head-on with that second major force we talked about, geopolitics. The economic story is no longer just about interest rates. Global tensions are now directly steering where money flows. And look, these aren't just headlines you skim past. They are active drivers of how the market is behaving. They're forcing a total rethink of our global supply chains. The conflict in Ukraine continues to warp energy and food markets. Tensions in the Middle East are putting critical oil shipping lanes at risk. And all the noise in the South China Sea threatens the very arteries of global trade. You put it all together, and it's speeding up this trend towards localization and bringing manufacturing back home, which means the potential for more tariffs and disruptions, that's now just a baseline assumption. For any investor, this adds a whole new layer of risk you have to think about. And this slide right here, this shows you the real-world financial consequence. Just look at that jump. Assets in defense sector ETFs have absolutely exploded, nearly 10 times in less than a year. This isn't just speculation, it's a huge structural pivot as countries ramp up military spending in response to all these threats. Money is flowing directly into the companies that build the hardware for a much less certain world. So, with central banks going their own way and geopolitics heating up, where is all the money actually moving? Well, this brings us to what people are now calling the Great Capital Rotation. So here's the crucial point. We are witnessing a clear shift away from the themes that really dominated the last decade. Capital is flowing out of growthy tech and speculative stuff like crypto, and it's moving into sectors that represent physical security like defense and things you can actually touch, hard assets and commodities. And inside that hard asset space, the story of silver is just incredible. It has been the absolute standout performer, more than doubling in a single year, leaving even gold in the dust. And here's why that's so important. Silver isn't just a precious metal you buy as a hedge. It's also a critical industrial component for things like solar panels and electric vehicles. It's got this dual role, a safe haven and an essential industrial input, and that is making it a prime destination for capital in this new environment. Now, on the flip side, even assets that were once seen as the ultimate hedge are feeling the heat. This number, that was Bitcoin's performance in November. It's a worst month of the year. And it happened right after a Fed rate cut that, in theory, should have been a tailwind for it. So, what gives? Why isn't digital gold shining? Well, this chart tells the deeper story. Stablecoin inflows, which are a really good proxy for institutional money, the big money entering the crypto market, have basically fallen off a cliff. They've been cut in half in just a few months. This tells us that the big players are rotating out. They're prioritizing tangible value and stability over speculation. You could say the smart money is quietly heading for the exits. And looming over all of this is one absolutely staggering number, the record high global debt. This creates an incredibly fragile backdrop for every single trend we've just talked about. When governments and corporations are this leveraged, any shock, whether it's from a central bank surprise or a geopolitical flare-up, gets amplified across the entire system. It really is like a house of cards in a windstorm. So, given this really complex and shifting landscape, how should you even begin to think about navigating it? It's pretty clear the old strategies just aren't going to cut it anymore. We need a new playbook for how we analyze things. First, and this is the most important one, you have to accept that this is a structural shift, not just some temporary cycle. The game has actually changed. Second, we have to redefine diversification. It's not just about a mix of stocks and bonds anymore. It's about building a portfolio that can handle a sudden energy crisis or a new trade war. Think geopolitical resilience. Third, when you're looking at hard assets like silver or copper, think beyond just inflation hedging. Consider their real-world utility in a world that is reindustrializing. And finally, prioritize resilience. In this environment, the companies with strong balance sheets and positive cash flow, those are the ones that are built to last. And all of that brings us to the question that really matters. The prudent strategist doesn't just react to the news cycle. They work to anticipate these massive shifts. The forces we've laid out are already in motion. And this moment in time is a perfect microcosm of the new reality we are all navigating. The old playbook from the last decade is obsolete. The real question is, are you ready to write the new one?